Welcome to the Ask Brad Show. Be prepared to hear ideas, concepts, and strategies that may challenge the way you were taught to think about saving and investing for retirement. It's time to roll up our sleeves and get to it. And now, the host of the Ask Brad Show, here's Brad Williams.
I remember when my mother was diagnosed with breast cancer, and the doctor told her what he proposed to do. The first thing she did was went and got a second opinion. The second opinion bore out the first, and she went through the procedures. So, second opinions can reinforce what you're doing. It can even change what you're doing. So, let's talk about second opinions, though, for your investments. Because this retirement that you're building and have built, that's everything you've worked for. So you want to make sure you don't miss anything, that you're on the right track. Okay? Because if you don't, it could turn into a financial disaster. And the problem is with retirement is that oftentimes you don't really know it's a financial disaster until it's too late. And that could easily be avoided with a second opinion. Welcome. This is Brad Williams and the Ask Brad Show. And today I got a great show on tap for you, because we're going to talk about just that, second opinions. You know, I think probably the biggest thing is getting a second opinion. It's often about loyalty. So when it comes to your money, maybe you've been working with the same broker, the same financial advisor for a long time. You might even consider them a friend. And loyalty is something we don't have enough of in this day and age. But what's important over loyalty, friendship is one thing, but when it comes to your money, that's another. What's the most important thing is getting the best possible advice for you and your family. Now, one issue some people have is procrastination. Some others, it's pride. They do it themselves. You look at it that, hey, I'm my biggest advocate. Nobody else is going to do this for me. But you know what? This is serious business, not about friendships. And the sooner you realize this, the better off you'll be. So on today's show, I'm going to reveal 7 reasons why getting an objective second opinion could literally save your retirement. And also, and this is important, the one red flag that's to send you running for the hills, and why your advisor may have a bias towards some investments or products. And that may not be in your best interest. It's just common sense. So often we look at second opinions. One of the biggest thing about the internet that I think is brought up is that when people are looking to buy a product, well, they'll check it out here, check it out there, check it out several places. You can get on Shop for Cars now and never set foot on a car lot. You've got the Carfax where you can find out if there's something wrong with it. So when you're doing all this diagnosis for your purchases, why not do that for your retirement? Why rely on just your opinion or your broker's opinion if you've been working with one for a long time? Sometimes getting a second opinion makes sense. One story I read recently in the paper about an 18-year-old girl, and she got a phone call from the doctor. She was working at a pizza parlor and was told she had a tumor on her ovaries and that she had basically 3 months to live. But she sought a second opinion, even a third opinion. And today she's 60 years old and cancer-free. So in her case, getting a second opinion saved her life. According to Gallup, 70 to 85% of people don't seek second opinions about a medical diagnosis. That sounds kind of crazy, doesn't it? Because there's an old acronym, PI. Anything painful, important, or expensive deserves a second or even a third opinion. So think about that, PI. Always remember that. Anything painful, important, or expensive deserves a second or even third opinion. So painful, important, expensive. Well, I would say those pretty much describe your retirement. It could be an expensive lifestyle that's important. I mean, it's your retirement. If you don't get it right, it could be painful. So it's really important to get it right. Let me tell you a story that happened to me back in 1982. I was playing racquetball with a friend, and there was some water on the court, and I was catching one off the back wall and spinning, and my foot hit that little bit of water that was on the court, and it caused me to corkscrew, and I dropped like a rock right there in the middle of the racquetball court. And fortunately, the gentleman I was playing with was a chiropractic student in his final semester of chiropractic college in Atlanta. And he knew exactly what I had done and made sure that the next morning I was at a sports specialist friend of his who helped start to take the pain away. Well, I also, coming from a traditional medical background, sought a second opinion, was told that I needed to get an operation on my back, that I had severely damaged my disc, and that the way to fix it would be an operation. Well, the sports specialist I was working with said, no, you don't need to do that. I can help you through this. And it was painstaking. My buddy would come pick me up at my place every day and carry me on a stretcher to the chiropractor. And that went on for probably about 3 weeks. I stayed in bed for 3 weeks. I wore a back brace for about a month. Then I started exercising again. Now, I want to bring something into perspective. This happened at the beginning of May in 1982. And when I got through the process, something important to me happened that I'd been working on for several years. Is that I was scheduled to take my first degree black belt test in Delaware that September. Well, I thought that was out. Well, with the work this chiropractor did, got me going. I really focused. And in September, I was there with the rest of them, and I took my test and passed it and got my black belt. So if I had listened to one doctor, I would have gotten an operation. I would still been recovering, and I would still have limited mobility today. So second opinions are important. From your financial standpoint, you got to look at what's the risk of getting a second opinion. Well, there's really no downside risk because you're in control. It's not that when you go see somebody, you have to do business with them, but it could be a way to confirm you're on the right course. I got a great referral from a guy once because his friend had come in, and I sat down with him, and after going over all his data and where he was, told him he really didn't need my help. He was doing a great job. And lo and behold, about a year later, I get a call from a person saying that he was referred to me by that gentleman. And I'm still working with that other gentleman today. So it's important to get a second opinion. Now, key thing that comes up a lot today is your advisor a fiduciary. So what does that mean? Well, are your financial decisions based on an advisor who's driven by commissions, or are they driven by someone who is working in your interest? Because a fiduciary responsibility is one that is working in your interest. And there's a suitability level, and then there's a fiduciary level. A lot of financial salespeople are on the suitability level. They ask you questions to find out whether what they're proposing to you is suitable for you. Not that it's necessarily the best thing for you, only that it's suitable. And a lot of the companies are looking at that, and they approve the use of that product or not based on its suitability. What's important is working with someone who is a fiduciary. They're going to act ethically with your best interest at heart. So when you're fiduciary, you're basically knowingly accepting the fact that you're acting in the best interest of that other person. So when it comes to managing your assets, it's all about making the decisions because they're right for that person, because they're furthering them on that goal. When you're working with typical stockbroker, for example, they're going to have a bias towards stock. And if you sell someone who only sells annuities, well, they're going to have a bias toward insurance products. It doesn't mean any of these products are bad. It just means that, when all you have is a hammer, most things always look like nails. So it's important that they have multiple tools in their tool belt. And so you don't get a second chance on this. Once you set up your retirement and you're going through it, that's it. And you want to make sure you make the right decisions going into it. Now, as I've mentioned on other shows about, me being my financial GPS for my clients, it oftentimes requires subtle course corrections along the way, but we're not talking about major corrections. So if you want to have that conversation with us, we'd be happy to look over your shoulder to help you ensure that you're on the right track. And let me show you how you can make the most of every dollar you've saved with your retirement. I make it easy and simple by going through a set process. I believe that a financial advisor should be a financial educator, that you should know the details of what you're getting into. and that you should understand why certain things are used. So if that's something that interests you, I can give you a no-cost analysis, no sales pitch, no products for sale. Just give us a call, 844-343-6048. That's 844-343-6048.
At Brad Williams Financial Services, our goal is to develop enduring, long-term personal relationships with our clients, knowing that you have placed your trust in our expertise and dedication. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048.
This is Brad Williams, and I have been privileged to have been an instructor over the last 12 years or so at the Osher Lifelong Learning Institute at the University of Alabama in Huntsville. They have some great course offerings. I'm currently teaching a course that I've written and taught for many years, Changing Face of Retirement in the 21st Century. But that's not all of the courses there. You can learn languages. You can learn hobbies, travel. There are so many things that you can get out of these courses they offer at the Osher Lifelong Learning Institute. So check it out today and come keep your brain working.
For more information on the Osher Lifelong Learning Institute, call 256-824-6183. That's 256-824-6183. Or email olli.info@uah.edu. The Osher Lifelong Learning Institute. Come keep your brain working.
Now, today we're talking about 7 reasons why getting an objective second opinion can literally save your retirement. You know, there are 5 critical elements of retirement planning. And if you're not looking at all 5 for your own personal retirement, that's a huge flag. That's a huge red flag. When you're working with your advisor, are you discussing Social Security, Medicare, taxes, income, fees, required minimum distributions? Today, I'm going to help you create a comprehensive checklist. And these are things you need to be talking about to your advisor. So get a pen and paper handy. If you're driving, just give us a call, 844-343-6048, and say, send us the checklist you talked about on the 5 things you need to know about retirement. If you're doing your own planning, this information could be critical for you. What matters most is getting the best advice for you and your family. You know, I do workshops on a regular basis, educational workshops. And, you know, it's always interesting that everyone comes in with a different story. And that means that everyone has different solutions. It's not a matter of, okay, take this test and see if you're conservative, aggressive, or moderate, and then we're going to put you in this cookie cutter portfolio. No, this is all personally designed, should be personally designed. Not everybody's got the same plan. You know, if you're not having discussions about taxes, Social Security, generating income, healthcare, talking about long-term care, inflations, required minimum distributions, you know, these are the conversations you need to be having. I think one of the biggest ones is taxes. Probably one of the most overlooked areas of investing. And it has a profound impact on your investments and your lifestyle, because just like in your income, it's not what you make, it's what you bring home. So looking at making sure your portfolio, your income plan is tax efficient as possible can save you lots of money. You know, taxes are a massive expense in retirement. Everybody needs to contribute to society, but why contribute more than you're required to? So it's paying what you need to pay and no more. And a lot of people confuse tax preparation with tax planning. They go to a CPA or an accountant or a tax preparer and they bring in their receipts, and then they get their taxes back. They sign them, they send them off, and they think, oh, sometime during that process that he's looked at my stuff or she's looked at my stuff, and they're going to tell me if they know any changes. Well, let me clue you in on something. In most cases, they don't have time to do that. They're working around the clock during tax season, and their objective is to make sure that all the boxes are filled out and everything's checked and that you're paying the right amount of taxes for your situation. They're not really looking at the fact of how can you change this situation. And some of the tax traps to watch out for require minimum distributions that you take once you hit 70 and a half. When you do those with your IRAs, your 401ks, you could pay a tremendous amount of taxes unnecessarily. One thing that might help would be a systematic Roth conversion plan. And that way, later on, you're getting tax-free income. The second item could be Social Security. And the way I look at Social Security, at least for people, 55 and up, is the backbone of their plan in retirement. That's kind of the foundation. One of the first things I do when I start working with someone is do a Social Security timing report, because Social Security is that steady, dependable income, and you need to make sure that you maximize it. But so many people leave tens of thousands of dollars on the table. And that's because claiming benefits is more complicated, more confusing than ever before. There's 2,728 rules in the Social Security handbook. And then there's hundreds of thousands of rules about those 27 to 28 rules. And that's their operating manual system. Forbes magazine reported that as much as $10 billion, and that's billion with a B, in Social Security benefits goes unclaimed every single year. So how and when you claim your Social Security not only impacts you, but it also impacts your surviving spouse. And it could trigger an avalanche of taxes. So there are some strategies that I help my clients with to show them that. And do you know what you pay in taxes to and where your income comes from affects your Medicare premiums? So claiming your Social Security at 62, for example, also changes what your spouse gets when you pass on if you're the primary earner. So again, that's tens of thousands, maybe even 100,000 or more. That's a key thing. Next is income. Retirement's all about income. It's building streams of income. It's not just how much assets you have. It's the income you're getting from it. Stock markets go up and down. I often show my clients that total return is growth plus income. Are you building your retirement on growth? Or are you building it on income? Because growth can be elusive. Growth can be negative. Look back at 2000 to 2003. We had nearly a 50% loss and then nearly 60% from 2007 to 2009. Did you get any growth those years? If you were depending on the price of the stocks in your portfolio going up so you could cash them in for your required minimum distributions or your income, you were sacrificing future income from that to do that. So it's having an income plan. Okay. Now, a lot of times when you hear these buzzwords on the radio or whatever about income, a lot of times they're talking about buying an annuity with an income rider. That's not what I'm talking about. Okay. That has a place, but not for everybody. But that's not what I'm talking about. I'm talking about using income tools to build steady, dependable income. Okay. So to get that income, you're going to have to make your money last. We're living longer, which is great, but that means you got to make your money live longer too. So a good way to look at it's a mortgage. If you've got a 30-year mortgage, when you make your first payment, most of it is interest and a little of it's principal. And so as you go through the 30 years, the next thing you know, you get to the end of it and the mortgage is paid off. Okay. So when you get into retirement, it actually can work the same way. So most of what I might be getting that first year is interest on my money. But if I'm sacrificing a little principal because maybe the market's down or that's my plan is eating some of the principal, do you realize that it works the same way that in 30 years that thing could be drained? Because the more you take a principal in the early years, the less interest you get in the later years. So when you're thinking about living to your 80s and 90s and you're retiring at 65, make sure you have a solid income plan and you're not depending on growth, that you're looking at the total return of your portfolio. And I'm not talking about bond funds, because there's some problems in that area too that I've done other shows on. So it's all about steady, dependable income. Then there's healthcare. People are going to spend upwards of $400,000 potentially for healthcare costs as they get older. So everybody who lives past 65 is going to need some form of long-term care, whether it's home care from their family or whether it's actual official, in a nursing home or assisted living. And those can get real expensive. The next area is inflation. You got to plan for that. So it's real important that you take care of taxes, that you take care of Social Security, make the right choices in Social Security, have a right income plan, have health care taken care of. And then there's inflation, because you've got to plan for inflation, because that will eat up your retirement. I remember when I was in high school, I worked at a theater. An adult could get into a movie at the theater I worked at for $1.75. What's the movie pass now? Like $12. Okay. So that's inflation. $1 in 1950 has the same purchasing power as 1023 today. So with the way they print money, with the way the Federal Reserve works, it allows the government to pay back the debts they accrue with cheaper dollars. Unfortunately, it's a hidden tax to you. So keep that in mind. So as we look at all these things, this overwhelms a lot of people. It's complicated and there's a lot of details to it. And that's why a second opinion is so critical, because what I'll do in that second opinion is help you focus on these 5 critical pillars to make sure you get everything you can out of every dollar you have in retirement. That you're looking at investing as you move into retirement, looking at more investing for income than from growth. And I outline those reasons why. So if having a second opinion makes sense to you, give me a call, 844-343-6048. Be happy to give you a free 1-hour consultation. That's 844-343-6048. And that way you can make sure you're on track. I think it's worth an hour of your time, and it'll be worth an hour of mine.
At Brad Williams Financial Services, we believe in innovative thinking, and we're not afraid to challenge conventional methods in our approach to managing, investing, and preserving wealth. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048. Thanks for listening to our show today. In retirement, you only get one chance to get it right, and we know that proper information leads to informed decisions. And that's why we hold free informational workshops in our area every month. Topics like Social Security, RMDs, the latest retirement tax strategies, IRAs, estate planning, and so much more. For dates and times of the next free workshop in your area, just pick up the phone. Give us a call today. Call 844-343-6048. That's 844-343-6048.
Welcome back. Now, we've been talking today about why a second opinion can be critically important for your retirement plan. It can help you figure out whether you're on the right track. You might see some gaps. You might find out that the financial products you're in are fairly limited to certain segments. That's why we're talking about the 7 reasons why getting a second opinion is so important. One big issue that I hear from a lot of folks as they start working with me is one of the reasons they came over is they didn't have a whole lot of communication with their advisor. One question I'd ask you is, when's the last time you heard from your advisor? When's the last time you ever went over your investment details with them? Did they explain their strategy long-term and short-term? Did they talk about your strategy and how you can avoid unnecessarily taxes, fees, and penalties? Have you talked about required minimum distribution? These are the topics of conversation you need to be having with them. Updating's a plan's a must. In one of my shows, I talked about how planes are off course most of the time, and that GPS brings them right back on track. Well, that's what a financial advisor should do, is those subtle course corrections along the way, not the big ones. And oftentimes, it's not just about the investment advice. It's the planning aspect of it, looking at taxes, looking at healthcare, looking at all those things I talked about. Have your goals changed? Does your advisor know that? The last time you had a face-to-face with them was 5 years ago. I would imagine your goals have changed. And although they may be keeping you up to date with reports and things they're sending you in the mail, maybe a phone call every now and then, but if your goals have changed and they don't know it, they really can't make adjustments for it. But that's something that should be initiated by the advisor. An advisor should be checking in, should be arranging those regular meetings, and see what's happened. Have you left an employer? Do you have a 401k now that you need to do something with? There's a lot of things that happen over time. If you're going to retire in the next couple of years, this is huge. Saving and investing is one thing, but it's what you do with that money. It's having a retirement income strategy. And a retirement income strategy is different than a growth strategy. In one of my shows, I talked about the retirement mountain. We have the ascent, which is accumulation stage. Then you have the descent, which is when you're coming down off the mountain. That's the distribution stage. Well, those are two separate phases of a retirement. If you're managing your money the same way in both, you're going to have some problems. Because as I highlighted in that show, most of the deaths on places like Everest come on the way down, not on the way up. On the way down, you're trying to make things last. You've used your energy reserves. You're now trying to manage it. And that's why so many deaths happen on the way down. And so don't let that be something that happens to your retirement. What's your plan for Social Security, for Medicare, for taxes, for income, for healthcare? Do you know what you're going to do for these? Have you had those discussions? Our 5-step retirement action plan focuses on the 5 important things that can help you make the most out of every dollar you've saved for retirement, including some of the great opportunities in this new tax plan. So you got to get the most out of Social Security. You got to make sure that you got the right Medicare plan, that taxes aren't killing you in that area. You got to make sure your money lasts as long as you do. Well, as I mentioned, if you would like to find out about our 5-step retirement action plan, have a free consultation to discuss how these affect you and do you have a plan for them, just give us a call, 844-343-6048. There's no cost, no obligation, no sales pitch, and no products for sale. Folks, this is just something I do for my radio listeners as a service. Just give us a call, 844-343-6048, and we'll be happy to give you that free consultation. Now, let's dig down a little deeper in this. As I mentioned about the retirement mountain, how you got the accumulation stage and then the distribution stage. The climb up the mountain is the accumulation stage. The descent down the mountain is the distribution stage. And, there's a lot of great advisors that are great at the accumulation stage, but their expertise is not in the distribution stage. Their investment tools, their expertise, maybe their companies are more focused on the growth side. Because I mentioned to you, total return equals growth plus income. And some years growth is elusive, whereas focusing on the income side, that's how you get steady, dependable income. So some advisors are better on the income side. Like I said, many of them are great at picking investments and letting it ride. Well, as we look at things now, you need to be constantly updating your plan because we're in the final legs, I guess, of a long upward market. So you need to make sure that you're not left standing when the music stops and you don't have a chair. As we look over, looking at your assets, making sure that they're in line with what you're wanting to do, because investing at 65 is different than doing it at 40. You have different objectives and your risk tolerances are different, especially if you're 75. It's a lot different than 40. So asset allocation, diversification, risk management. These are critical pillars of any financial game plan. You got to have properly diversified financial game plan. And it's got to mirror your appetite for risk. So when the market turns down, you don't need to be stressing. You don't need to be losing sleep. So you've got to have a risk management plan for that today. And we're in this for the long haul. If you've ever heard that before, that's not a risk management plan. Okay. What is the long haul? All right. When you're 40 years old, the long haul is to 65 or 70. Okay. When you're 65, what's your long haul? If you have a 30, 40, 50% decline in your portfolio in the next 5 years, what is that going to mean to the end of your retirement? It's going to mean a lot different retirement than you planned for. So, I've been in this business 31 years. So I've watched. In fact, I remember when I left my corporate job to get into this industry in 1987, it was about 6 months into it that the crash in October of 87 hit. I remember sitting there on the couch watching CNN when they actually reported the news and was thinking, wow, what did I do? Did I make this huge mistake? And, it came back, and it does come back. Sometimes it takes longer to come back than others. One thing I do is I educate my clients in market history, because market history is really important to understand the long-term aspect. You can't predict the short-term aspects of the market, but long-term trends. You can look at those and see that they're cycles, and they're fairly predictable cycles. So historically speaking, we're overdue for a bear market. I mean, we just are. And can you afford to lose 50% like in 2000 or nearly 60% like in 2007 or 2008? I mean, we've seen that twice in the last 18 years. Is it on the horizon? Don't know. Could be a year, could be another 2 years. But you need to get back to fundamentals. Do you know the investments you own? Do you know your asset allocation? Do you know the downside risk? Do you know what would cause you to sell any of your investments? You got to know the answers to these questions. And the sooner you do, the better off you'll be. Another thing to look at is fees, expense transparency. One of the fastest ways you can improve your rate of return is minimizing investment fees and expenses. It's another case of 1%, 2%, or 3%. Doesn't sound like much over a short period of time, but long term could add up to tens of thousands, possibly more. 92% of Americans don't know they have fees in their 401k plans. 72% don't believe they're paying anything. Nothing could be further from the truth. So you got to look at that. Cutting fees by 1% could make your money last an additional 10 years in retirement. So when you look at the hidden fees and backdoor payments, they're costing Americans billions of dollars a year. So if you can reduce your fees, you can make your money last longer. Regularly when people come in to see me, when they show me their statements, and we're going over this in our first meeting, and I look and they're paying an advisor a management fee, that advisor has them in mutual funds. They're paying a fee out of those, and a lot of them aren't aware they're paying fees to the advisor to put them in the mutual fund, and then fees to the mutual fund for managing the mutual fund. So that could be an area you look at. The bottom line is, of all this we've talked about, as you plan for retirement, you got critical choices. They're forks in the road, and you're at one today. Decision could be about your advisor, could be about Social Security, taxes, income, the risk you take. Every one of these decisions is going to come with consequences, good or bad. I mean, we can talk about this all day long, but specific strategies for every person are totally unique to you. Minor differences in age, assets, risk tolerance trigger major shifts in your strategy. That's why relying on some rule of thumb or one size fits all, where you come in and take the test and they say either conservative, moderate, or aggressive, and then put you in that group of investments, may not be the right thing, because that could be growth oriented when you need income. Just remember, when you transition from the accumulation stage and you finish climbing the mountain and you're coming down the other side and you're going into the distribution phase, you need to have your portfolio focused on income, and not growth. So, as I mentioned, our 5-step retirement action plan, where we focus on the 5 biggest issues that can help your money go further in retirement. It's up to you. There's no sales pressure to do anything, but I can promise you this. Your meeting will be educational, and you'll walk out of there with some solid tools and solid knowledge. Whether you work with me or not, you're going to come out of there with an hour. Hey, most people spend more time planning their vacation than they do their finances. Why not take an hour, find out if you're on the right track? Just give us a call, 844-343-6048. We can schedule a time to meet, review your situation. It's informal, but I'll ask you some basic questions. You can share your thoughts and then share the ideas that I have and see if they can change what you're doing, maybe make it better, whether you're do-it-yourself or whether you're working with somebody else. It'll be an hour well spent. 844-343-6048.
At Brad Williams Financial Services, we understand the struggles that families and business owners face today. We want to help you develop, implement, and monitor a strategy that's designed to address your personal objectives and individual situation. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048.
A good retirement plan is about income. How much money you've saved is not as important as how much income you're going to have. A sound income plan should take into account the timing of your Social Security distribution. If you're taking a pension, did you take a survivor option and why? When you're taking your required minimum distributions from your IRAs at 70.5, are they coming from growth? Are they coming from dividends and interest? Because that could be a disaster if it's coming from growth. Timing when to start each stream of income is just as important as the tax implications of each stream of income. If you're looking for an advisor to be more of a partner for you and your spouse in retirement, call Brad Williams Financial Services at 844-343-6048. Call today and schedule a free 1-hour, no-obligation consultation to discuss your goals and aspirations and see if we're a good fit. That's 844-343-6048.
Have you missed any of today's show? Would you like to listen to past shows? We've got you covered 24/7. Visit AskBradShow.com. That's AskBradShow.com.
Wanted to break from our usual format today, and I've been thinking a lot, and I've got a book that I'm going to make available to y'all that I've read several times, and I just recently read it and thought, I need to really talk about this on my radio show because this could help a lot of people. And I think what it really boils down to is when we look at how things are today, the markets are crazy. We've got 200 and 300 point swings every day. We've got uncertainty overseas. There's just a lot going on. But we still have a stock market that's really has gone pretty long-winded. I know some people say, well, it's still undervalued, and some people say it's going to crash any day. The fact is, nobody knows. They just nobody knows. So when you're looking at doing your own planning, you can be the eternal optimist and just think, well, the market's going to continue to go up. You can be the pessimist and think, oh, everything's going to crash tomorrow. But in reality, when history plays out, it's a little of both. And you got to be prepared for that. And it's all about the timing of your retirement. It really, truly is about the timing of your retirement. Think about this. Let's say that you were getting ready to retire and it's 1999 and market's been going crazy, since 82. We had the longest peacetime expansion from 82 to 2000 in the history of the country, and you are looking pretty good. And so you decide to retire and you decide to get much more conservative in your investments, and you're feeling pretty good because you're looking at income generating things, and you got your pension, you got your Social Security, you got retirement income from your investments and IRA. And then we think about, well, what happened if you would have retired in 2001? Well, there would have been a totally different attitude because we began the severe market correction in 2000 that lasted to 2003. And really the same story could have been repeated in 2007. If you had retired in 2007 at the peak of the market, but if you had waited a year or so in 2008 or into early 2009, you would have seen a significant drop in your portfolio. And so you have to step back sometimes and say, okay, yeah, I need to have some money in equities. I need to have some money in the market. But what are other issues? What are other ideas? And how does this coincide with the new tax bill, tax planning, and all these complicated matters? Do I go back to the history books and just repeat what's been done over and over again? But we're in a new world today, folks. There's a lot changed. Things are moving a lot faster than they used to. Companies come and go quicker than they used to because technology changes. You look at 10 years ago, commercial real estate was still very strong, and it really, in my opinion, never has recovered from the crash in '08. When you look at some of the stalwarts in industries like McDonald's, McDonald's is playing defensive now. That used to be a guarantee. If you got a McDonald's store, you were pretty much guaranteed to be a millionaire. And that's not the case anymore. There's all kinds of market pressures. So the question we have to ask ourselves is, can we solve new world problems with old world solutions? I mean, that's really what it boils down to. And so looking at things and what some people would consider thinking outside the box, that's real critical, because you've got to think outside the box when you're planning for your retirement, because there's all kinds of contingencies you've got to take into account. As we look at where our country's gone, and one of the reasons I think we need to be looking at new world solutions is our country's facing something that we've never really faced before. And that is a mountain of debt. I mean, just a mountain of debt. When you think about the fact that from George Washington all the way to the end of Bill Clinton's administration, our national debt had accumulated to somewhere around $5 trillion. Think about that. That's a lot of money, isn't it? $5 trillion. And then by the end of George Bush, it was at 10. And then at the end of the previous administration with President Obama, it had gone to 21. So think about that. $21 trillion. That's our national debt. And when you put that into perspective, the government's going to need a lot more revenue to pay that debt down. Yeah, growth will help, and maybe some of the new policies are going to bring us growth to help us grow out of it. And that's a good thing. But when we look at, we've had an unusually and artificially low debt, with all the quantitative easings that had gone on to stimulate the economy. They have really exploded the money supply. And when you think about the fact that, from what I've studied, 10-year treasuries average somewhere around 4.5% historically. And depending on which study you look at, they got up over 15 during the latter part of Jimmy Carter and the first couple of years of Ronald Reagan. But as Reagan's policies kicked in and that changed that, and interest rates came down, it bottomed out, I think it was in 2012, at 1.41 for the 10-year treasury. Now think about that. Banks and insurance companies use that as a benchmark for what they price their products in. And that's why things like long-term care insurance have been impacted so negatively, is because the insurance companies couldn't make enough margin on what they were making on their money to sustain those. What the government's really done is they financed all this debt on an adjustable rate mortgage, people, because, you got all these mounds of short-term, medium-term debt, and it's got to be constantly rolled over. We're now seeing that come to fruition as interest rates rise. Now, the Federal Reserve's not going to be able to rise them tremendously fast, or they'll shut the economy down. So they're really kind of walking a razor's edge, so to speak, because they can't go too far one way or the other. So when we look at, that's why I bring back the issue of new world solutions, because we've got to look at what is going to happen. The government's going to have to raise income taxes. I mean, they're just going to have to, because they've got to pay down the debt. I mean, when you think about it, what our industry, what our financial planning industry has done is, when yields start coming down, they started, because they're always looking to come up with new products and new solutions. And so They kind of exchange having end-of-life balances for the safe money quote or income planning quote. And so that's basically where you use something to buy a lifetime income, and, there may not be any left when you die. And that is a solution. Don't get me wrong. I'm not putting that solution down, but really it doesn't guarantee anything for your family at the end of your life in most cases. So when we look at how the adjustments have been made to calculations that a lot of the industry groups use to furnish education for us as advisors, that's really changed. It used to be they had a 5%. You could build $1 million up, take a 5% withdrawal rate, and you're pretty much assured not to run out of money before you die. And then that got dropped to 4 after the financial crisis in 2008 because of the steep drops that had happened twice between 2000 and 2009. And they've recently come out with a report that was in 2013. It was called Low Bond Yields and Safe Portfolio Withdrawal Rates. And folks, what they said in that is that if you want to be reasonably assured not to run out of money before you die, and when I say that, I'm talking about it's not that you're going to have all your money left. It's not going to be gone. That your withdrawal rate, a safe withdrawal rate, is 2.8%. Now think about that, 2.8%. So put that in context of $1 million. That's $28,000 withdrawal rates from that account in a given year before taxes on $1 million. And that only gives you about a 90% chance of not running out of money before you die. Okay. That's kind of scary. And so surely there's got to be other solutions, because when you kick in some of the volatility and things like that, you've got to be calculating what kind of income you're going to need, especially required minimum distributions. And see, everything's changed. I mean, we went as an economy, it used to be, everybody had not everybody, but majority of people had a defined benefit plan, which is where, the company put aside a certain amount of money for you every year, and that based on years of service and high five or however they calculated your income while you were working, you got a set benefit amount for that period. Lifetime, you could get a spousal rate for a discount, things like that. So this is what I'm talking about with new world solutions, because we can't apply old world solutions to them. Today, younger workers are having to rely on 401k because not many pensions are available to workers anymore. And we're seeing those companies that do, they're rapidly dropping those things because the liability in low interest rate environment for a company to maintain that really puts a strain on their business. Look at the Rust Belt companies that had a lot of legacy costs with pensions, and that killed them. Now, earlier in the show, I mentioned that I was going to give away some books. There's a great book by Matt Zagula called Smart Retirement. And what I'm talking to you about today is the smart retirement. You got to change the way you're thinking and look at things in terms of strategic movement around retirement taxation. That's what I'm talking about, folks. Strategic movement around retirement taxation. And so it's another strategy. And I think this is a great book for that. I'm going to give away, normally I give away 3 copies. This week, I've got 5 copies of this available, just 5, for the first 5 callers at 844-343-6048. That's 844-343-6048. And those first 5 callers at 844-343-6048 will get this book. You just will get in touch with you when you leave your information, tell you how you can get a hold of it. I think it'll change the way you're thinking about a lot of things when we start talking about that. I think what's important is when we look at the new world issues. One of the new world issues is that we have now reached a point where some things have kicked in that were set up a long time ago. I mean, the 3 big important date for retirees today is January 1st, 2008. And that is when the first boomer became 62 and was eligible for early Social Security. So that's January 1st, 2008. Now, the next one would be January 1st, 2011. And I'm sure a lot of my astute listeners already figured that one out. Well, that's 3 years from 62. That must be Medicare. That's exactly right. Because at that point, if you weren't still working, Medicare became your primary health care provider. And where did that come from? Well, a lot of that burden is paid for by the government. Yes, you have paid taxes into that, but that's a huge burden from the government simply because that money wasn't set aside. No, they can talk about trust funds all they want, but once politicians figured out that they could take an IOU and put it in there and spend that money, what do you think they did? That's exactly what they did. So when you look at what that's going to mean, U.S. government debt to GDP, gross domestic product, is it at unsustainable levels? So what's the government going to do about that? And that's why I think that discussing a smart plan, strategic movement around retirement taxation is important and should be discussed, because the first fix is raise taxes. That's the easiest way. Go from 15 to 20%, from 20 to 25. That's the quick and easy way. It's not always politically popular, but it's happened. The second is a little less obvious. It's rollbacks. For example, when Congress first started taxing Social Security benefits, and before, when Franklin Roosevelt set it up, he said, if you give your money to this old age and survivor pension benefit, it'll never be taxed. Well, that changed. And then they raised taxes again on it. And so that's what I mean by a rollback. Another way of rollback is in Medicare, where they just tell physicians, and my physician listeners out there who have Medicare patients will know exactly what I'm talking about, where they just say, well, we're not going to pay that much this year for that particular procedure. We're going to pay less for that procedure. So there's ways the government gets it back. They've got to get it back. So those are some of the key things that need to be looked at. Another big one was June 15, 2016. Now, how many people out there? Let's take a second. Ask yourself, what significance is that? Well, a big one, I'm telling you, for baby boomers and for everybody from now on, because that was the year that the first boomer turned 70 and a half and started their required minimum distributions from their qualified retirement accounts. That's the point, ladies and gentlemen, where the IRS and the government has said, okay, well, you've gotten to save all this money tax deferred, and now we want our share. And how that works is there's a table that is an IRS life expectancy table. There's actually several. There's one for spouses who are much younger. There's one for inherited IRAs, but that's not the one I'm talking about today. I'm just talking about your standard life expectancy, single life expectancy table. And what happens is at age 70 and a half, there's a factor on there. You divide all your IRAs and it tells you out of all of them what you have to take. And what that really breaks down to is a withdrawal rate of 3.649, because the factor you're going to see in the table is 27.4, where they're telling you, well, we're projecting at age 70 and a half, you've got 27.4 years left to live. Okay. And we want all that money out by then. And again, before we close today, I'd like to make that available one more time. I got 5 copies of SMART, and that's the SMART Retirement. And I will be giving those to the first 5 callers, 844-343-6048. 844-343-6048. Well, we're at the end of another show. I want to thank you all for listening. I hope this was informative and entertaining, and I look forward to visiting again with you next week. Have a great week.
That's all the time we have for today. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048.
Investment advisory services offered through Sound Income Strategies, LLC, an FCC-registered investment advisory firm. Brad Williams Financial Services and Sound Income Strategies, LLC are not associated entities.